You're sitting in your HDB right now, perhaps it's a 4-room or 5-room flat. And somewhere in the back of your mind, you could be thinking, should I keep or should I sell? Or should I just wait and see? So today I want to show you what the path actually costs with real numbers and real life comparisons and what a different decision could look like instead. Let's go. Hi everyone, my name is Shaun and I am a real estate consultant here in Singapore, and I love sharing such real estate content and analysis right here on my channel so they can help you to navigate the real estate market confidently. So if you like such content, I would appreciate it if you could hit the like and subscribe button. Thank you. A quick disclaimer about everything that I'm sharing today is all for educational purposes, and I do want to leave with you something that you can actually use for your own property journey. Before we start the discussion today, let me lay out what the typical path of a homeowner in Singapore actually looks like. So this is what I call like a passive or do nothing kind of mode. Let's say you apply for a BTO at around age 28 and you wait for another 3 to 4 years for your keys, and then after that you fulfill another 5 years of your MOP, and by then you're around perhaps 37 years old, and then nothing. You just live in it all the way for about 20 odd years. So by the time you retire, what most people normally do is that they will perhaps right size to a smaller flat. So sell the big flat and buy a smaller one and use the remaining cash for retirement. So in this scenario, let's say you started with a $450,000 BTO, which was very much the going rate not too long ago, and you held all the way to retirement. So the realistic cash balance you could perhaps walk away with is around $300,000. Now I want you to sit with that number for a while. $300,000 cash at age 60 or 65. Looking at some statistics here is that life expectancy of Singapore residents has risen to about 83.5 years back in 2024. And at the same time, there's also inflation which is quietly eroding the purchasing power every year. The question to ask ourselves here is that, do you think that this amount of cash here for retirement is sufficient? Most people have actually never looked at this number. Perhaps you should rather ask yourself, could this same time and capital be put into much better use? Before we look at the numbers, I just want to bring you through in terms of property holding as an asset class in Singapore. Hard kind of assets can mean things like property, land or gold. These are the kind of assets that can protect our wealth over the long run. Think of them about it in two ways. So firstly, they are seen as a safe haven. So when the economy gets uncertain, when stocks market crash, property often tends to hold its value, especially here in Singapore. So you have seen this back in 2008 or 2020, every major economic shock, Singapore residential property has proven to be resilient. Secondly, it's also an inflation hedge. So the right property doesn't just hold its value, it also grows beyond inflation. In fact, it actually compounds. So the goal here is to use this fuel strategically, especially during the time when you have your peak income earning years, and then to acquire and to grow these hard assets. In this context here, I'm referring to real estate here in Singapore. And that's how actually wealth compounds over time. Instead of just sitting perhaps in the bank or perhaps in your CPF OA earning, let's say 2.5% interest until you're age 65. Now here's where it gets a bit more interesting, because holding onto a property is one thing, but the strength of the asset that you hold is another thing. The concept here is correlated to the speed and quantity in which the supply of a particular property asset class can be increased when demand rises. So if the government can easily build more of something, that helps to keep the prices more controlled in a way. So if the supply is hard to increase, when demand rises, what happens is that prices will be pushed up and they often stay there. Apply that concept to Singapore's housing market. So if we look at this in the broad sense of Singapore's residential market, we can see that for HDB flats, the government can and does ramp up supply aggressively. So they have told us this explicitly, is that their intention is to keep HDB flats affordable. So that is actually a good thing for social policy. But as an investment strategy, it means your upside is managed. So every time demand spikes, what happens is that supply will follow. The ceiling is built into the system. However, let's say we shift our focus to private condominiums. In a way, it is more limited. The supply is in a way more controlled depending on GLS and collective sales. So it takes years from land acquisition to launch to completion. So the secondary market is in a way more smaller and less controlled. That is why condos, particularly in the OCR and RCR, have consistently outperformed HDB appreciation over time. Now if we look at the final category of residential property, landed properties here, they are almost completely inelastic because there is basically no new landed supply here in Singapore. So land is finite and a very specific chunk of it is designated for landed housing. So when demand goes up, prices go up as a result, and they often stay much at a high level. Let us get more more specific here on the supply side of things, because this is where the numbers actually really matter. So in 2025, roughly 8,000 HDB flats were reaching their minimum occupation period and entering the resale market. That's actually one of the lowest figures in years. One of the reasons that prices have stayed elevated for a period of time. But look at what's coming. Here in 2026, the number actually jumps approximately to 13,500 units. In 2027, about 15,000, and 2028, close to 19,500 units. So that's actually a more than doubling of MOP supply hitting the resale market over the period of 3 years. All at the same time that the government is also pushing out 55,000 new BTO flats from 2025 to 2027, and even shortening waiting times for certain BTOs. There are more sellers in the market now and more choices for buyers, resulting in more competition in the resale market. So now think about what historically happens to any asset class when supply suddenly doubles or triples against flat demand. It puts pressure on prices. So that doesn't mean HDB prices will collapse. It means that they have a strong floor supported by government policy and genuine housing demand. But the premium upside that resale HDB have been enjoying over the last few years, that window is probably closing. When you add that into the macro perspective in terms of the life cycle of a HDB flat, the remaining lease, as well as in terms of your CPF accrued interest, I think this picture is getting a bit hard to ignore. Now that I've shown you why HDB precision is structurally limited, I want to get into something more specific, because I think that's what most people don't really think about when they decide whether to hold on to or sell their flat. So let me start with the big picture over here, because I think the history here is genuinely important. So look at the HDB resale price index over the years. You can see that between 2008 to 2013, prices ran up actually quite significantly. In fact, it ran up about 79.5%. So that's almost close to double. But because that was when supply couldn't keep pace with demand during that period of time. So couples couldn't get their BTOs fast enough, and everyone flooded the resale market as a result, which was very much similar to the time during 2020 during the COVID period. As a result, prices really shot up significantly. Then in January 2013, what happened is that the government stepped in and they introduced a series of cooling measures where MNSR was tightened and loan tenures were shortened, and PR restrictions were also added. So as a result of these cooling measures, what happened is that prices fell about 11.98% off the peak at that time, and then after that it basically flatlined for a good period of about 6 to 7 years. So now look at where we are today. You can see that actually there's a parallel in terms of the entire scenario that is happening, and history is playing out again. So you can see in the same sequence that prices ran up sharply from 2020, driven by COVID construction delays. HDB resale prices grew 12.3% in 2021, 10.4% in 2022, and then started slowing. And in 2025, the growth rate came in at just 2.9%, which is the slowest rate since 2019. So if we look at quarter 4 of 2025, we can see that it reflected a 0% growth quarter on quarter. Basically, it is flat. In fact, the latest news that came out regarding the HDB resale prices is that it dipped 0.1% in quarter 1 of 2026, so marking the first ever decline in nearly 7 years since 2019. But based on this, what can we see that the government is doing? We can see that they have applied the exact same playbook as back in 2013. So, but this time with 4 rounds of various cooling measures since 2021, plus also ramping up supply with 55,000 new BTOs from 2025 to 2027. So it was also reported that the strong BTO supply will also help to reduce demand in the resale market and also moderate resale flat prices. The question that I would like to really pose to you today is that if this happened before, if prices ran up and the government did introduce policies and intervene in terms of the ramping up the supply, and prices stayed flattened for about 6 years, what makes you think that it won't happen again? So because right now, every single condition that preceded the 2013 correction is present. And peak prices, there's government intervention and supply flooding the market as well. So let us take a look at some actual transaction numbers on the table. Jurong West area, in this particular block 678B, you can see that a 5-room flat in this block transacted at 558,000 in March 2013, which was right at when the peak period occurred. The same unit type, the same block transacted at 445,000 when we fast forward to September 2013. That's 6 years later. So actually that's a loss in a way of 113,000, which is initially the the cost of holding it for another 6 years. So now we shift to another area which is in Punggol at block 646. So 5-room flats at that time were going for about 595 to 650,000 in late 2012 to early 2013. So if we fast forward to March 2018, which is about 5 years later, the same units were transacting at about 406,000. So that's a price drop of nearly 200,000 over that holding period. So now Tampines area, block 715, you can see that prices peaked at 509,000 in August 2013. So there were 0 transactions in 2014. Market completely froze after the cooling measures. Prices then just gradually declined from there. So those who held from 2013 hoping for another run-up had to wait years just to get back to where they started. So now I want to be very clear is that I'm not showing you this example just to scare you, but 2025 is not identical to 2013 because prices have recovered significantly those lows, and also the market environment is very much different in various important ways. The underlying dynamic here is that the government did really step in when prices get too high and ramps up supply, and as a result, prices did show a flattening in terms of the price index. So that dynamic is structural. So it has played out before, and the conditions for it to play out again is put in place right now. If let's say you are someone that is really looking to perhaps upgrade or switch to a stronger kind of asset, should you continue to wait out, or should you really look at the data here and really make a decision from a position of information? So let me add one more layer to this, is that because I think this is something that really catches most people off guard. Because let's picture this together. Let's say you bought a 4-room flat at $470,000. So you've been paying the mortgage with your CPF for years. You've been diligently doing the right thing. And then when you eventually sell off, what happens is that you think that you could be walking away with a good amount of profit, right? But you need to factor in something called CPF Accrued Interest. When you use your CPF to pay off for your flat, in terms of your down payment and your money mortgage, that money has to be returned back to your CPF OA account when you sell your flat. Plus the interest that it would have earned if you left it alone at 2.5% per year. Let me just run you through the numbers quickly to let you see how the numbers actually add up in real life. So let's say on a $470,000 4-room flat, which is financed by CPF over a 25-year loan, by the end of year 6, you have owed $25,000 in accrued interest back to your CPF. So by year 15, that figure is over $108,000. And by the end of the 25-year loan, you have owed yourself $899,000 in total CPF principal plus interest, of which $286,000 is purely accrued interest that is compounded over time. So this doesn't disappear when you sell. It comes right from your proceeds actually. So the longer that you hold, the more that it accumulates every single month, and then the lower the amount of cash on hand that you actually get when you finally exit. So of course it's not a penalty. The money does go back into your CPF OA, which you can reuse for your next property purchase. But it means that the amount of cash profit that you thought that you will be walking away with could be significantly lower than the simple headline appreciation number would suggest. Let's close off this section with some numbers to put everything into perspective. So let's say we compare two people, both 30 years old with the same starting point. Person A here buys a 4-room flat at $750,000 and holds it all the way to age 65. And by the time that flat perhaps has grown to $950,000, reflecting a $200K gain over 35 years. He or she then chooses the right size by selling and buying a 3-room HDB for $600,000 with a remaining cash balance for retirement of $350,000. So spread that over 20 years, let's say up to age 85. You're looking at $1,458 a month to live on for retirement. But let's say we take a look here at person B, same age but chooses to swap the HDB to a private condominium at $1.8 million at the same starting point, and then hold on until age 65. Then that condo grows to $2.2 million with a $400K gain. They then choose to right size into a 3-room at perhaps $700,000. So this will reflect the amount of cash for retirement, which is about $1.5 million. So if we spread that for over 20 years, that will be about $6,000 over dollars per month for retirement. So the difference between person A and person B is the $1.25 million in terms of capital. So that difference play out in terms of a difference of $4,700 per month for retirement, which can really reflect a big difference in terms of lifestyle and also choices as well. A property decision that is made at the right time with the right asset can result in a very different upon reaching your retirement years. So, and here's the thing that should really make you think. Both people started with roughly the same financial position at age 30. The outcome isn't driven by income. It isn't driven by luck, but rather it is driven by the asset that they choose to put their capital into and when they choose to do it as well. That's the real cost of holding your HDB and doing nothing. in this entire video, I just want to be clear is that I'm not trying to say that everyone should be rushing to sell their HDB, but rather for those that have intention to, let's say, move on to a stronger asset or perhaps to upgrade in terms of their property holding, and then they are also having the ability to, in terms of their income earning power, to really upgrade and do something in terms of building their asset and also building their capital, then I think this video should be a very good sign and really good reminder for yourself to look at the data and really make a more informed decision from now. So of course, everyone's situation is different in terms of your family needs, your income, and your timeline, as well as your objectives. So what I'm saying is that if you have been sitting on the fence for a while because it all just feels too complicated or too expensive, or you're not sure whether the numbers actually work for you, the uncertainty could actually be costing you something. Perhaps it's possibly hundreds of thousands of dollars over time. The first and most important step is always clarity. What are your actual numbers? What are your financials? What does the NAV actually look like in your own specific situation? And that's what I do. So if you want to find out more, you can reach out to me for a one-to-one session where we will deep dive into your numbers for your own specific situation. So I hope that you have found this video really helpful. And once again, if you want to stay tuned for more of such content and analysis, please hit the like and subscribe button. I will appreciate it a lot. Thank you, and I'll see you in the next one. Bye.